Hello and welcome back to the channel. Today we will be discussing about transfer pricing audit. With the liberalization of trade and foreign exchange policy beginning in the year 1991, India has begun to integrate its economy with the global economy. This has resulted in an increase in cross-border movement of goods, facilities, finances, and now even intangibles. Obviously, with the increasing number of multinational enterprises interested in India, it has now become critical for Indian tax authorities to be aware of transfer pricing issues. The transfer pricing regulations were implemented through the Finance Act 2001 in India by substituting Section 92 and introducing new sections 92A to 92F in the Income Tax Act and some important rules 10A to 10E in the Income Tax Rules of 1962. The regulations applied to relevant international transactions entered into on or after April 1, 2001. Transfer pricing laws were introduced with the goal of providing a detailed statutory framework that can lead to the computation of reasonable, unbiased and fair profits and tax in India in the cases of international firms. The legislative intent influencing the transfer pricing laws is to prevent profit shifting by attempting to manipulate prices charged or paid in international transactions, thus stripping away India's tax base. Now let us discuss transfer pricing audit in India. To combat the practice of foreign companies avoiding the tax audits in India, the legislation known as Transfer Pricing Regulations containing the provisions of transfer pricing audit was enacted for this purpose. A transfer pricing audit investigates the pricing of transactions involving two or more related associates. It is determined whether the transactions are conducted under market conditions and will withstand the Income Tax Department and other tax authorities' due diligence by applying and documenting various test methods. All Indian companies are required to analyze the international transactions in the light of transfer pricing regulations and to adhere to them by keeping proper transactional records and documents. A transfer pricing audit must justify why a particular method was chosen for the enterprises and transactions under review. Under a transfer pricing audit, a fact-finding exercise is conducted in order to assess the organization's numerous functions as well as the potential risks that each activity may confront. Thereafter, an appropriate mechanism or a method of transfer pricing is chosen and the parties who have been tested with it are identified. Later, a survey using data from various national and international sources is conducted to discover companies that may be benchmarked for the chosen company, and detailed financial analysis using that data is executed. On the basis of the analysis, the assessee compiles a consolidated report and properly records it. The Indian Income Tax Act of 1961 requires you to submit a report in Form 3CEB. Some of the important points of the law pertaining to transfer pricing audit are as follows. Each individual or organization that has participated in an international transaction is required by law to keep an up-to-date record of each transaction. All income earned by the business as a result of any international transaction must be determined at arm's length price. If two or more reasonable prices are assumed for a particular transaction, then the arm's length price is calculated by taking the average of the prices. Under the supervision of a chartered accountant, the individual or group participating in an overseas transaction should file a report of transfer pricing audit in Form 3CEB at the conclusion of the financial year. This form must be completed and sent before he files his income tax return for the same period. The group or individual who does not follow these rules is liable to pay the penalties as may be imposed by the board. Now let's discuss about Section 92E. Under Section 92E of the Income Tax Act, the persons entering into an international transaction or a specific domestic transaction are required to provide an accountant's report. Any person who entered into an international transaction or a specified domestic transaction in the previous year must obtain a report from an accountant in the prescribed form, duly signed and verified by the accountant before the specified date. The audit applies to both international and domestic transactions that satisfy some specified criteria. Form 3CEB must be completed and submitted. In addition, the accountant must express a view on whether the assessee has retained appropriate information and documentation as are prescribed in respect of the overseas transactions or certain domestic transactions that are entered into by him. The Chartered Accountant's report needed to be furnished by Section 92E includes all the information as is required by Form 3CEB. In order for the accountant to be able to answer any questions before the tax authorities that may emerge later, he must make precise notes regarding the evidence he relied on throughout the test as well as all of his working papers. The report of transfer pricing audit is divided into 3 paragraphs, each of which deals with a different topic. The first paragraph includes a declaration and states that the assessee's accounts and records will be examined in order to review the international transactions and certain domestic transactions in question. The second paragraph entails expressing an opinion on whether an assessee has kept proper information and documents as required by Rule 10D in respect of the identified international transactions and specified domestic transactions. The third and final paragraph requires the accountant to express his or her opinion on whether the information in annexure to Form number 3 CEB is true and correct. Now, let us discuss the penalty on failure to submit a report under Section 92E. Section 271B of the Income Tax Act states that if a person to whom transfer pricing provisions apply fails to give an accountant's report as required by Section 92E, the assessing officer may order the person to pay a penalty of 100,000 rupees. This penalty is imposed if a person fails to provide an accountant's report, and it can be enforced by the assessing officer. To conclude, Section 92E requires the entity carrying out an international transaction or a specified domestic transaction to provide an audit report from the accountant in a prescribed format. This report must certify the nature and amount of transaction and must be filed with the income tax return. Form 3 CEB must be completed for this purpose. For more such content, please like, share and subscribe to the channel. Thank you for your time.